Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. We released our monthly India market outlook titled A Tight Balancing Act, and over the course of next week, we will be releasing a series of podcasts summarizing our key views. First, a quick performance check so far in 2022. Continued upward shifts in markets' expectation of central banks' terminal policy has been the key driver of volatility throughout 2022. A bird's-eye view of asset class performance may suggest a favorable risk environment, with Indian equities delivering about 3% returns since we published a Market Outlook 2022, while most major markets remain in bear market territory. However, the journey has been volatile, with true drawdowns of more than 15% during the course of the year. Bond yields have inched higher amid higher interest rates and hawkish central banks given rising inflation, with the benchmark 10-year Indian government bond yields up over 100 basis points and corporate bond yields up over 200 basis points. INR gold has risen by about 6%, demonstrating its safe haven credentials, while USD INR continues to trend lower, hitting new all-time lows and depreciated by over 8%. So given this backdrop, what is our outlook for asset classes going ahead? India's economic growth and earnings outlook remains robust and ahead of major peers. This has in part supported the performance of Indian assets relative to peers so far in 2022. However, the hawkish policy stance and continued upward shifts in markets' expectation of central banks' terminal policy rates has raised the risk of a recession for major economies and increased the probability of further near-term downside for equities. Further, Indian market valuations are quite expensive, both absolute and relative to peers, indicating a very low margin of safety. Finally, we also see increasing value in bonds and cash, especially relative to equities. Now, given this backdrop, we have become a bit more balanced in our asset class outlook, as having a narrow focus can lead to excessive exposure to one asset class at a time when the outlook is increasingly uncertain. Therefore, we believe a core holding that allocates across major asset classes with a greater focus on themes, sectors, and tactical opportunities makes sense for investors. Moving to individual asset class view, Indian equities are downgraded to core holding given stretched valuation, both absolute and relative to peers, and has reduced the margin of safety. However, fundamentals remain strong for equities given above-trend economic growth, still resilient earnings expectation, and far less restrictive monetary policy. Within equities, we prefer large-cap equities over mid-cap and small-cap equities on relatively better macro fundamentals and greater margin of safety in terms of earnings and valuation. Among sectors, we adopt a more domestic sector tilt with a preference for value sectors like financials and industrials and defensive sectors like consumer staples. Bonds remain a core holding as attractive yields are counterbalanced by lower yield premiums, weak fiscal dynamics, and worsening government bond and demand supply balance. Rising interest rate is another headwind for bonds. Within bonds, we retain our preference for short maturity bonds given lower sensitivity to rising interest rates. Cash continues to remain a core holding given attractive cash yields. And finally, coal remains a core holding and a good portfolio hedge against elevated inflation and equity market volatility. That's it for today. Do reach out to your relationship manager for a copy of our India Market Outlook. Thank you for listening, and if you enjoyed the podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.